Very good evening, everyone. How are you all? Everyone, first, can you update me? Is it audible, everyone? Yes, Vineet. Very good, very good evening. Is my voice is audible? Yes, sir, audible. Okay. So first, any doubt in means? Of course, we are discussing RTP. We have till now we have done question number one to question number 10. So any doubt in question number one to question number 10? If you have any doubt in this RTP, whatever we have discussed in last 2 days, you can ask me first. Then today we'll take another 5 questions from RTP. Means question number 11, 12, 13, 14, 15. No doubt? Okay. So come to question number 11. It is related to India's 105. Very simple question. Company X has identified one of its division disposal group to be sold to a prospective buyer, and the board has approved the plan to sell the division on 30th September 2001. The sale is expected to complete after 1 year, but it still qualifies to be held for sale under Appendix B of India's 105. Cost to sell the division is estimated to be 10 crore to be incurred in March 2003. The fair value of division is 400 crore on 30th September 2001 and 31st March 2002, and the carrying value is 500 crore. How shall such division be measured under Ind-AS 105 on the following two reporting date: 30th September, 31st March. Consider a discounting factor at a rate of 10% for 1 year and 1.5 year has been given. Now just try to understand the question. They have given two dates. First date they have given 30th September 2001. Second date they have given 31st March 2000, 31st March, 30th September and 31st March 2002. Correct? And this is the date when it is classified as held for sale and is expected to be sold after 1 year. Understood? It is expected to be sold after a period of 1 year. And they have given this is 31st March 2003. Means you can read the question once again. What they are saying, the cost to sell the division is estimated to be 10 crore to be incurred in March 2003. Means expected date of sale is 31st March 2003. So you can see this is 1.5 year, 1.5 year, and this is 1 year from this. Now the carrying amount is given how much? 500, and the fair value is given how much on this date? It is 400, and this is also fair value given how much? 400 only. But can you see we need to find out cost to sale, and cost to sale will be incurred. How much will be incurred on this date? It is given 10 crore. So we need to find out a present value of this cost to sale. The present value will be what? 10 crore multiplied by the discounting factor, and the discounting factor has been given how much? 0.867. So it will be cost to sale will be 8.67. 8.67. So fair value less cost to sale become how much? It is 400 minus 8.67 is equal to 391.33. And if you want to calculate present value as on this date, so it is 1 year, it will be 10 crore multiplied by 0.909 It will be 9.09. So what will be your fair value less cost to sale? It will be 400 minus 9.09, that is equal to 390. 390.91. So can you say on this date, on 30th September, it will measure at 391.33. And of course, the difference between the carrying amount and fair value less cost to sale will be charged to profit and loss account. Will be charged to profit and loss account as an impairment loss. Means subsequently, you can see the fair value is now 390.91, and this is only because of what cost to sale. Means you can see cost to sale has been increased from 8.67 to 9.09. So what Ind AS 105 says that if discounting has been used to calculate the cost to sale, means if the present value has been present value technique has been used to calculate cost to sale, so any increase in the cost to sale will be considered as what? Interest cost. Interest cost. So this, whatever you can see, whatever the difference, this 391.33 and 390.91 is because of cost to sale only. So this will be recognized as finance cost in SOPL. And this should, have you understood this particular point? If you read the answer, come to the answer, you can see as on 30th September 2001 it is 391.33, as on 31st March 2002 it is 390.91. The increase in cost to sale, the division by 0.42 crore, will be recognized in PL as a financing cost in accordance with the Ind AS 105. This is the only point which you need to understand. Very simple. Yes, sir. Can we go to Ind AS 2? Ind AS 2, this question, I will say simple question, but to a different type of question they have given for the first time. Inventory. A Limited began operation in the year 2001-2002. In 2001-2002, it incurred the following expenditure on purchasing the raw material of its product. Purchase price of raw material, this will be added to find out cost of purchase. Import duty and other non-refundable purchase tax, this will be also added. Refundable purchase tax, this will not be added. Freight cost for bringing the goods from supplier to factory storeroom for raw material, this will be added. Yes, sir. Cost of unloading the material into storeroom, this will be added. Packaging, this will be added. On 31st March 2002, A Limited received 530 volume rebate from a supplier for purchasing more than 15,000 from supplier during the year. So any rebate will be also deducted. The rebate will be deducted, reduced. It will be reduced. So we can find out cost of purchase. Cost of purchase. Then A Limited incur the following additional cost in production. Means now they have given either cost of conversion, either it will be direct labor or production overhead. You can see salary of the machine worker in the factory. So this is direct labor will be added. Salary of factory supervisor 3000. Okay, this is production overhead. Production overhead. Depreciation of factory building and equipment used in the production overhead. This is also production overhead. So this will be added. This will be added. Consumable used in the production process. So any consumable whatever used in production overhead, that will be also added. But can you say this is variable? This is variable production overhead, but this will be also added. Depreciation of vehicle used to transfer the goods from storeroom for raw material to the machine floor, this will be also added. Factory electricity, this will be also added. Factory rent, this will be also added. Depreciation of entities vehicle used by the factory supervisor, this will be also added. I mean, these are all our production overhead. Yes, sir. During 2001-2002, A Limited incurred the following admin expense. Normally, admin expense will not be added, but if it is directly attributable for bringing the inventory in present location, then it will be added. Correct now. So, depreciation of administrative building 500, depreciation and maintenance of vehicle used by admin staff 150, and salary of admin personnel 3050. Of the admin expense, 20% is attributable to administrating the factory. So can you say out of this 1, 2, 3, 20% will be production overhead because that is for administrating the factory. Correct. So 20% will be attributable. Remaining expenses are attributable in equal proportion to the sales and other non-production operation. So remaining expense will not be added. In 2001-2002 means remaining expense is attributable in equal proportion to sales and other non-production operations. So that is not added to the cost price of inventory. In 2001-2002, A Limited incurred the following selling expense. Yes, selling expense will never be added. To this, all three will never be added. Past necessary journal entry means they have asked journal entry to record a cost price of inventory in the books of A Limited. So what journal entry will do, that we need to understand. Correct now. So I hope you have understood what is added and what is not added. Once you have understood this, we can understand the journal entry. Let me explain this particular point with solution only. Chalega? Yes, sir. You can see first journal entry they have done inventory account debit to cash or bank with the cost of purchase. Cost of purchase already we calculated how they have calculated. You can see everything whatever I have said that has been added. This become cost of purchase. Correct. Then they have calculated the cost of conversion, direct labor, fixed production overhead. You can see everything, and then variable production overhead, indirect material consumable. What journal entry they have done? They have done inventory account debit to bank for this. Inventory account debit to bank. Then for depreciation and maintenance of factory equipment, so it will be what? Depreciation and maintenance expense. No, depreciation so it will be the journal entry what? We need to increase inventory and decrease PP. So we'll do what? Inventory account debit to PP. So for this inventory account debit to PP, inventory account debit to PP, inventory account debit to PP. For factory electricity, inventory account debit to bank. Factory management, inventory account debit to bank. Factory rental, inventory account debit to bank. Other costs. For depreciation once again inventory account debit to PP. And for what? Admin staff cost is inventory account debit to bank. Then variable production overhead, you can see you have used some indirect material. Means your inventory, means your this finished goods will increase, inventory of finished goods will increase, and inventory of consumable will decrease. So inventory, account debit to inventory, you'll see. So what journal entry they have done? Let us see. Let us see what they have done. You can see inventory account debit to cash or bank, property, plant and equipment, property, plant and equipment, cash and bank. You can see that same journal entry they have done. Then last me inventory account debit to inventory consumable store 200 200. This journal entry they have done. Super easy. You can do it by your own. At final level, this is very easy. Got it? Simple. Correct? Yes, sir. Come to the next question. Question 13. It is a good question. Already it has been incorporated in my question bank. I have taken from GFRS and same question they have given in what? RTP. So some question normally I take from GFRS and I have seen that in the coming RTP they will also take from GFRS book only. GFRS means one elective paper whatever you have. Beside manufacturing plant, A Limited has various other assets not used for operational activity. Example freehold land, township in different location, and excess of office space rented to ABC Limited. Also A Limited has some land which are kept vacant as per the government regulation which are required that specified area around the plant should be kept vacant. The details of which are as under. A Limited office building registered office. A Limited registered office in Delhi is a 15-story building of which only 3 floors are occupied by A Limited. So 3 floors will be property plant and equipment, whereas the remaining floor are given on rent to other companies. These agreements are usually for a period of 3 years. Accordingly to A Limited, such excess office space will continue to be let out on lease to external parties and have no plan to occupy it at least in the near future. So can you say this excess office space means whatever the floor which has not been used will be classified as investment property? Yes, sir. Some flats in township located in location 1. As regard township in location 1, there are approximately 2000 flats in the said township. It was built primarily for A limited employee. Hence, approximately 80% of flats are allotted to employee. To whatever flats which has been allocated to employee will be property, plant and equipment. And the remaining flats are either kept vacant or given on rent to other external parties. A lease agreement is signed between A Limited an individual party for every 12 months being 1st April to 31st March. The lease entered is cancelable lease. Also, beside monthly rent, additional charge are levied by A Limited on account of electricity, water, cable consumption. Accordingly to A Limited, there is no intention of selling such excess flat or allotting it to employee. It is given to can I say that the 20% flat will be classified as investment property because can I say it is given on rent and there is no intention to what allocate such flat to their employee. Understood? Yes, sir. Then flat in township located in location 2. Understood? Understood? Correct. There are 1000 flats in location 2 of which 400 flats are given to employee. So this will be classified as property plant equipment. 350 are given on rent to central government and state government for accommodation of their employees. This will be investment property. And 250 flats are kept vacant. And 250 flats are kept vacant. And now they are vacant and nothing has been given. So if suppose we assume that this will be held for giving on rental in future, then this will be classified as investment property. Or it will be held for giving or allocating to employee, then it can be classified as property, plant and equipment. Understood? That depends upon intention how it will be used in future. Got this point? Yes, sir. Then hostel located in location 1. 60 rooms in hostel have been let out to G Limited to give accommodation to their personnel. The 60 rooms will be what classified as investment property. This agreement is prepared for every 11 months and renewed thereafter. Beside the monthly rent amount, some charges are levied towards water, electricity, and other amenities, cable connections. So this entire hostels will be classified as what? Investment property. Then land located in location 1, what they have given. In 2004, A Limited purchased a plot of land on the outskirts of major city. The area has mainly low-cost public housing and very limited public transport facility. The government has planned to develop the area as an industrial park in 5 year time, and the land is expected to greatly appreciate in the value if the government proceeds within the plan. A Limited has not decided what to do with the property. So can you see it is held for capital appreciation and therefore it will be also classified as investment property. Very easy. Then land in location 1. A portion of land has been leased out to C Limited for its manufacturing operation. Can is classified as held for earning rental income. So classified as what? Investment property. Land in location 2. A portion of land has been given on rent to D Limited. This is also what? Classified as investment property. Determine the classification of property which are not held for operational purpose. Means only we need to find out the classification of those property which are not held by the company. With suitable reasoning, reasoning also need to be given to you know the meaning of investment property that you can give as a reasoning. Understood? Easy. Simple. Can we go? Come to question number 14. Entity A and B establish a 50-50 joint operation in the form of separate legal entity. In the form of separate legal entity. It is a joint venture. Entity J, whereby each operator has a 50% ownership interest and take 50% output. So it is a joint operation. Okay. On formation of joint operation, entity A contribute a property with a fair value of 110 lakh and intangible asset with a fair value of 10 lakh, whereas entity B contribute equipment with a fair value of 120 lakh. The carrying amount of these assets contributed by entity A and entity B is 100 lakh and 80 lakh respectively. What will be the amount of gain or loss to be recognized by entity A and entity B in its separate financial statement as well as in consolidated financial statement? Correct now. Now what India's 111 says that whenever any asset has been contributed by joint operator to joint operation, correct now. So it means it is nothing but it is carrying on transaction with other party. It means it is doing transaction with not with joint operation, it is doing transaction with other party. In that case, the joint operators are recognized gain or loss resulting from such transaction only to the extent of other parties' interest. Means they should recognize gain or loss only to the extent of other parties' shares. Understood now? This is the concept. So in this case, if you understand, we are doing question number 14. If you see, there are two party A and entity A and entity B. This is joint operation. So what entity A has contributed? Entity A has contributed what? Fair value 110 lakh and intangible asset of 10 lakh. So total asset fair value is what? They have contributed 120 lakh. And what is the carrying amount of this asset? Carrying amount is how much? 100 lakhs. What they have contributed? Asset whose fair value is how much? It is 120 lakhs. 120 lakhs and carrying amount is 80 lakh. 120 lakh and 80 lakh. It means in the books of A, in the books of A, correct. Can I say 50% of this will be recognized? 50% of this will be recognized means we can say in this way, if PP or in time whatever asset is coming, I am saying asset of B will be recognized. That is what 50%, that is 60. And what will be going out? Can I say this 100? So that will be going out, but only to the extent of 50%. We will say asset of A will be reduced, that is 50, and the difference will be gain. So gain will be how much? 10. So this much gain will be recognized. 10 will be recognized. Similarly, in the books of B, can you see we recognize asset? This 120 we recognize means to the extent of 50%, that is 60, and whatever asset will de-recognize. So it is this 50% of 80 will be de-recognized. 40. So how much gain will be recognized in the books of entity B? So gain will be recognized only to the extent of 20. Gain will be recognized only to the extent of 20. So you can calculate gain in this way. However, in solution they have given statement format. You can do in journal entries base also, but in exam follow what is statement format. I hope you have understood this. Got it? Good question. It is also a good question. Simple. Understood? So we recognize only gain or loss to the extent of other party shares. Means any gain or loss on transfer of any asset to the extent of joint operator share will not be recognized. Understood? In the respective books. Got it? Yes, sir. Come to the question 15. Today it was very simple question. In day 36, it is a good question. Similar question has been given in ICAI study material or RTP MTP. It is repeated type of question. On 31st March 2001, Jackson Limited purchased 80% of equity of Kaplan Limited for rupees 190 million. The fair value of net asset of Kaplan Limited that were included in the consolidated balance sheet on 31st March 2000 were measured at 200 million. Correct? It is the group policy to value the NCI in subsidiary at the date of acquisition at its proportionate share of fair value of subsidiaries identifiable net asset. So can you say from this we can work out goodwill? Let us work out goodwill first. We are doing question number 15. So what will be the goodwill? Goodwill will be what? Purchase consideration given how much for 80%? This is given 190. Then NCI for 20%, it will be, they have given how much? 200 millions. 200 millions fair value of net asset. So this become 20%. It become 40. So this become 230. What is the fair value of INA? Fair value of INA is what? 200. So what is the goodwill? Goodwill become 30 million. So goodwill, and okay, this is a partial goodwill. This is partial goodwill. How much? 30 million. This you have understood? Yes, sir. Let us read the second paragraph. On 31st March 2004, means 2002-2003, after 3 years, Jackson Limited carried out an annual review of goodwill on consolidation of Kaplan Limited for evidence of impairment. No impairment had been evident when the review were carried out on 31st March 2002. and 31st March 2003. Means for the first 2 years there was no impairment loss. The review involved allocating the asset of Kaplan Limited into three CGU and computing the value in use of each unit. The carrying value of individual unit before any impairment adjustment are given below. You can see unit A, unit B, unit C. They have given intangible asset, property, plant, equipment, current asset. So this is the carrying amount of CGU. This is value in use. So recoverable amount. If suppose fair value less cost of disposal is not given, we will assume recoverable amount is equal to value in use. It was not possible to meaningfully allocate the goodwill on consolidation to individual CGU, but all other net asset of Kalpana Limited are allocated in the table shown above. Means what they are saying that goodwill cannot be allocated to smaller CGU, means goodwill be allocated to larger CGU. It means we need to two-stage impairment testing. Yes, sir. The intangible asset of Kaplan Limited have no ascertainable market value, but all the current assets have market value that is at least equal to their carrying amount. The value in use of Kaplan Limited as a single CGU on 31st March 2004 is 350 million. Recommended treatment of impairment goodwill. So can you say first we'll perform first stage impairment testing? So we'll do first stage impairment testing. So what they have given? Unit A, B, C. Correct? Yes, sir. What is the carrying amount? Carrying amount is given how much? 170, 90, 100. So carrying amount is given 170, 90, 100 is carrying amount of CGU. We'll compare with recoverable amount. Recoverable amount is given how much? 180, 66, 104. 180, 66, 104. So what is the impairment loss? Impairment loss. So in this case it is nil. It is 24 and it is nil. This 24 will be allocated first to goodwill, but there is no goodwill. It will be allocated to PP, an intangible asset. It will not be allocated to what? Current asset, because current asset is outside the scope of India's 36 chapter. Got it? Yes, sir. So it will be allocated in the ratio of carrying amount. It will be allocated in which ratio? 50 is to 10. In this ratio, it will be allocated. Correct? Yes, sir. So it will be allocated in the ratio of 50 is to 10, means 5 is to 1. So 24 divided by 6 into 5. So it will be 20 and this will be 1. So we can find out revised carrying amount. Revised carrying amount. Understood. Now we'll do second stage impairment testing. Second stage impairment testing. We will find out CGU A, B, C. So CGU is how much? It is 170 carrying amount. CGU B will be now 66 after what? Impairment loss, after impairment loss, and this will be how much? 100. And how much goodwill? Goodwill is how much? Already we calculate 30. What is the total of this? The total is what? 170 plus 66 plus 100 plus 30. That is how much? 366. And this become total carrying amount of the Kaplan Limited. Recoverable amount is given how much? I think recoverable amount how much given? Is given 350, na? Is given 350 million. Recoverable amount given 350 million. So impairment loss is how much? Correct. But one mistake we have done. Here goodwill is partial goodwill. So first we should do grossing up. Yes, sir. So this is 80%. So we'll add what? Plus unrecognized unrecognized share of NCI and goodwill. So how much? 30 divided by 80 into 20. So can a 7.5 will be added? So this will become 37.5. So total become how much now? 170 plus 66 plus 100 plus 37.5. So this become what? 373.5. Now we'll compare with what? Recoverable amount, that is 350. So how much impairment loss? Impairment loss is how much? Minus 350. So it is 23.5. So this will be allocated, but this will be 80% parent company and 20% NCI. So 23.5 into 80%. So your impairment loss will be how much? 23.5 na? 1 minute. Yeah, it is 23.5. So what will be the impairment loss? 18.80. 18.80 will be impairment loss attributable to parent company. Understood? This whatever you have not recognized, for that impairment loss will not be applicable. So this is not applicable. Means out of 30, how much will be impaired? So 30 minus 18.20. How much? 30 minus 18.20 is equal to what? So the carrying amount after impairment loss for goodwill will be 11.20. Understood? Have you understood? Correct? Okay. Can we take one more question today? We can take question 19 also. Sorry, in days 19. Question 16. Come to this. Question 16. Very good question, but similar question we have once again in what? ICAI study material. Arun, Arunachalam Limited operate a defined retirement benefit plan for its current and former employee. Given the large size of the company, it engaged a firm of actuaries for the advice on the contribution level and overall liabilities of the plan to pay benefit. Following details are given below. On 1st April 2001, the actuarial valuation of present value of defined benefit obligation was 15 crore, and on the same day the fair value of asset of defined benefit plan is 13 crore. Correct. So what we should do in this question, we need to find out actuarial gain loss on DBO as well as in plan asset. So we'll make a statement, reconciliation statement. Reconciliation statement for DBO and plan asset. So what is the opening balance given? Opening balance given how much? It is 15 crore. It is 13 crore. Okay, sir? Yes, sir. Then what is given? On 1st April 2000, the annual market yield based on government bond is 5%. So we can add interest. We will do plus interest on opening balance. It is 15 into 5%. It is 0.75. And it is 13 into 5%. It is 0.65. Chalega? Yes, sir. Then during the year ended, Arunachalam made contribution of 1.75 crore into plan asset. So it is plus contribution. We'll do plus contribution. So plus contribution, and this will be adjusted in plan asset. How much contribution? It is 17.1.75. So we'll do 1.75. Correct. Then what is given? And the plan paid out benefit of 1.05 crore to the retired member. So this benefit paid 1.05. So we'll do minus benefit paid. Minus benefit paid. Can I say this will be reduced from both DBO and plan asset because the amount will be withdrawn from plan asset and will be paid to employee. This will reduce your what? Defined benefit liability also 1.05 crore. Yes, sir. Then what is given? The actuarial firm estimated the current service cost is 1.55 crore. So we'll add current service cost. We'll add current service cost of 1.55 crore. Correct. Then what is given? On 28 Feb 2002, the rules of plan were amended with retrospective effect, which lead to an increase in the present value of defined benefit obligation by 37.5 lakhs from that date. Means it is a past service cost. The past service cost will increase what? Past service cost will increase your DBO. So it is 30. How much? It is 37.5 lakhs given. Lakhs. It will be 0.375. So 0.375. 0.375. Understood this point? It is given lakhs, we converted into crore. Yes, sir. Then what is given? During the year ended 31st March 2002, Arunachalam was in negotiation with employee representative regarding the planned redundancy. These negotiations were completed shortly before the year and the redundancy package were agreed. The impact of this redundancy was to reduce the present value of defined benefit obligation by 2 crore, and before 31st March 2002, Arunachalam made a payment of 1.875 crore to the employee, and this payment were made out of retirement benefit plan. So benefit paid is 1.875. So we'll do minus, one second, minus benefit paid is 1.875 and 1.875 benefit paid. But can you see there will be one gain on settlement? So gain on settlement is how much? Minus gain on settlement. It is 2 crore minus 1.875. So how much gain on settlement? That is equal to 0.125. That is the gain on settlement. So entire present value of DBO will reduce by 2 crore only. Yes, sir. Correct. Then what is given? On 31st March, then closing balance is given. So first, can you give me this balance? First, can you give me this balance? Just worked out. Is coming how much? It is 15 plus 0.75 minus 1.05 plus 1.55 plus 0.375 minus 2. This is coming how much? 14.625. And what is the closing balance given for this? Closing balance given how much? It is 17. So you can see your liability increases by what amount? So you can see minus 17 is equal to 2.375, 2.375 crore. So because your liability increases, so it is a loss. We will call it actuarial loss or remeasurement loss. Understood? Similarly, we'll do for plan asset. So 13 plus 0.65 plus 1.75 minus 1.05 minus 1.875. This is coming how much? 12.475. And what is the closing balance given? 14. You can see your asset increases, so it become remeasurement gain. So 12.475 minus 14 is equal to what? 1.525. So 1.525. This become remeasurement gain. This become remeasurement gain. So there is one remeasurement gain, there is one remeasurement loss. So what is the net? What is the net remeasurement loss which will be transferred to OCI? This 2.375 minus 1.525 is 0.85. So this become net remeasurement loss which will be transferred to OCI. Now they have asked the extract of financial statement in this question. Now that you can do, it is very easy. Once you have understood this, the extract will be very easy. Can we come to the solution only? If you come to solution, from that only I can explain now. You can see what is given. They have prepared what? Extract of balance sheet. The present value of DBO. This is closing balance. This is opening balance. Fair value plan as this is given the question only. So that becomes net defined benefit liability. This you can find out. Then extract of SOPL. Then is a current service cost will come. Past service cost will come. Gain on settlement will come. And net interest cost will come. Net interest cost. Net interest cost is interest cost minus interest income. Whatever we have recognized based on 5%. Understood. So this will be what? Total amount transferred to PL. Now extract of OCI, they will transfer net remeasurement loss to, you can see, actual loss, and they have done that only loss and the gain. The net amount is 85.85. We calculated, they have given in lakhs. Correct. Now they have prepare account. We can also prepare account. Means they have given the working note either based on account or based on statement. Follow statement because that will be what? Time save, because that will save your time in exam. But it, so this is what entire question whatever I was supposed to do today. So we have done 6 questions today. So only some questions are left. With also what I will do tomorrow also, I'll take some amendment. Means whatever amendment is related for November 2023, that also I will discuss. Okay, whatever is given in this RTP. So only 4 questions are left with some amendment that will do tomorrow. Okay, sir. Correct? Got it? So for today this much only. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.